Another Think with a Drink. This is the weekly webinar series brought to you by the Aries Foundation for Financial Education. Tonight, we're going to talk Social Securities and literally claiming strategies for Social Securities. Before we start up, a quick little checklist here. One of the things I'm going to start with is, for anybody in the audience, we apologize for the color scheme. We were choosing what we thought was a fall color, and it didn't really work. So just know we'll never use this color scheme again. But unfortunately for this presentation, this is what we're stuck with.
Well, it kind of looks like summer squash.
Yeah, well, see, I was trying for the fall thing. It just didn't work. So anyway, the event is being recorded, as you just heard and just found out. But don't worry, it's only what's being shown on the screen, your image, your name. None of that is in the recording, so you will never be part of that. Your microphones are muted, like you keep those muted. There is a chat box, so if you do have questions, please drop them into the chat box. I'll introduce my co-pilot in a second, Craig, who's here to sort of man the chat box, but also keep me on pace for this evening. Speaking of your pilots for tonight, my name is Tom Alessi. I am the president of the Aries Foundation for Financial Education. I have been in financial services now for 23 years. I am an investment advisor. That means I act as a fiduciary whenever giving advice or guidance to any of my clients. As I said, I'm going to bring my vice president in. Craig, can you introduce yourself?
Yeah, sure. So I'm Craig Richardson. I've been in the financial services area for about 17 years. I specialize in working with families and small businesses to help them come up with personal financial plans so that they can achieve their future goals.
Appreciate that. And like I said, Craig will be chiming in as we go along, but he's also there in case questions pop up into the chat box. So as we said, this presentation is brought to you by the Aries Foundation for Financial Education. We're a nonprofit. You can check us out at www.ariesfoundation.org. The mission behind the Aries Foundation is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you're in a relationship with your money. And just like every other personal relationship that you have, there are behaviors and emotional triggers that can cause us to act sometimes irrationally when it comes to our monies and finances. All Craig and I are trying to do, the whole Aries team, is trying to help everyone get a better handle on that, take some of that emotion out of dealing with your money. So some disclosures before we start up. The presentation is meant to be purely educational. We share these presentations on our website. We share them on our YouTube channel. All we ever ask is that if you're going to share this information, you do it in a purely educational manner. The Aries Foundation for Financial Education is a nonprofit, and we are not affiliated with any broker-dealer or securities-related business, and we are not a registered investment advisor. The Aries Foundation, myself, Craig, the rest of the team, we are always going to recommend to you that if you ever have questions, legal, tax, or financial, that you seek out the help of a professional to get guidance and some advice on that. All right, that was a lot of wording for me. And now we get to the fun part of this. And the reason we call it Think with a Drink. So a lot of this stuff is, a little bit sometimes complex, sometimes convoluted, sometimes a little bit of doom and gloom. So we like to put a little bit, even though we try to keep it educational, a little bit relaxed and casual in terms of that. And we can't think of a better way to do it than if we have something cold and refreshing to sip on as we go along through the evening. For tonight's beverage, I have chosen Timber Yard Brewing. They're in East Brookfield, Mass, if you've never heard of them. And since I was trying to do a fall theme with this, I've got their Oktoberfest for this evening. Craig, what are you drinking tonight?
I actually have a selection from our friends at Scout and Cellar. I'm drinking a Fieldhouse white wine blend.
Nice.
Yeah.
That's going to the wine route. So I'm going to pour this and say to everybody out there, hopefully you have something cold and refreshing to sip along as well. And I will say skål. Okay, got a little, I can taste some of that, the maltiness there with that. All right, so let's go into Social Security, understanding Social Security. And really this is about, forward thinking, but you got to look at what's happened in the past and where we were to what's come from and where we're at now in terms of Social Security. So before it used to be 65, right? 65 was the number. And, we did this whole thing on retirement where where it's usually the number one question that we get from everybody, right? If we ask the question, when are you going to retire? Or when you were thinking about retire, at what age do you want to retire? The knee-jerk response is always 65. And that's because that's what it was before. You know, at 65, people would get a pension. They'd have Social Security. They'd have guaranteed health care in the case of Medicare for the rest of their life. They'd get a gold watch and a lawn chair. You know, that's basically what retirement used to be. Nowadays, however, it's completely changed. It's much more complicated. It's not 65, it's 62 or 67 or 70. You know, we've got Social Security, you got Medicare, you've got RMDs, you've got HSAs, you've got inflation, we're living longer. All of these are factors that play into making some of these decisions. And that's really what this is about having the conversation and sort of understanding what happens when you claim and how you can be affected.
And you don't get the gold watch anymore, right?
No gold watch. Well, I don't know. I mean, you know, it depends on how long you were at the company, possibly. But most of the time, there's no gold watch. Right. So one of the issues is we are living longer. The statistic from last year in 2020 is that a healthy couple, age 55, that the average life expectancy for the female is going to be 89, for a male is going to be 87. That's average life expectancy. And Craig, what does average mean?
Average means the middle, means some people will die sooner and some people will live longer.
Right. So just realize that the likelihood that if you were healthy at 55, that one of you probably is going to live into your 90s. Now, that might be horrifying to some of us, but you know, the idea is that the statistics say that more than likely you're going to be into your 90s, which means we have to be thinking about longer term as far as that income stream than we had before. Because before it used to be about 20 years. It was 65, I was going to live till I'm 85 and then I'm done. Not anymore. Now it's you know, 90, 92 is where we're looking out in terms of trying to figure this all out.
Yeah. So you spend a third or better of your life in retirement, actually.
Correct.
Yeah.
It is the longest vacation you are ever going to take.
Yeah.
All right. So, you know, let's just talk some basics, some real quick parts of Social Security before we get into the claiming strategy part of it, right? So, you know, everybody pays in to Social Security. You contribute 6.2% if you are a W-2 employee. Your employer puts the other 6.2 in on your behalf. If you're self-employed, you're putting the whole 12.4 in yourself, right? This doesn't count Medicare. This is just the Social Security portion. Medicare adds another 3% in, but that's a different story. So this is right now, we're just talking about the Social Security portion of FICA. And so that's the 6.2% that you are contributing, and your employer matches that 6.2% for the total of 12.4% that you're putting in. For 2021, that contribution amount is $142,800. That's what it's gone up to. That's the limit. You make more than that, you got no Social Security contribution. There's no FICA at that point for that piece, right? 142.8 is the limit. So up until that, you're making a contribution to it. And there's really two ways to qualify. One is what they call working quarters. That means you've worked for at least 10 years, 4 quarters in a year. You know, or you were married to someone who did the same, right? So in 2021, you earn 1 credit for every 1470. So that's really what it is you've got to earn 1470 in a quarter and you get 1 credit, 4 credits per year. Can't earn more than 4 credits in a calendar year, but for every 1470 that you've earned, that's a credit. Next quarter looks at it and calculates it. So as long as you've done 40 quarters, you're qualified, you're going to get a benefit. I'm taking another sip, Craig, if you have anything to add.
Well, so yeah, most of the time you get a benefit depending on whether you have a state or federal pension.
That's a different conversation.
Okay.
We're just talking about basic in terms of
I'm just trying to cover our bases.
Yeah, you were going sideways on me there. All right, so then Social Security, if you've never talked to Social Security, or if it's something that you're looking at that's going to be coming up, they love, like every other governmental agency, to throw acronyms at you, right? So there's acronyms for everything. But the two main ones are FRA, which is full retirement age. And we'll talk about what the qualification is for full retirement age in a couple of slides. And then PIA, which is your primary insurance amount, which is what you get on a monthly basis. That's what everything is based off. So you have your full retirement age, and we'll talk about those numbers where they're at, whether it was 65, 66, 67, et cetera, that everything is based off, and then what that primary insurance amount is that you are going to get at that point. So that's how this whole thing works, and that's how they're going to talk to you about it. And so when we look at claiming, now this is for somebody whose primary insurance, whose FRA, you can see the red box in the middle of the page, is 66. So this would have been somebody born in 1954. So if you were born in 1954, your FRA is 66 years old. That's where your primary insurance amount in this particular case would be $1,600 a month at your FRA. If you choose to claim earlier, less than your FRA, for every year that you are early, you can start claiming at 62, but it's going to deduct the benefit amount by 6.25% every year. So that if you look at it, if you go and if you said this was me, I was my FRA was 66, I could claim 1,600 at that age, but I've chosen to take my benefit at age 62, I'm only going to get 1,200 a month. And there's no makeup, there's no do-overs, there's no mulligans. Once you choose, you're in. That's what you got, and you're going to get it for the rest of your life. This goes back to the conversation about, hey, you know, if you're somebody who's more than likely going to be on the other side of that average, well, that 1,200 is not going to be worth a whole heck of a lot once you get into your late 80s.
And Tom, people may have had stories about how you could elect one option and later pay that money back and elect a different option. That's off the table now, right?
It's only, so it does still exist in the single year that you claimed. You do have the ability to hit the pause button in the year that you claimed and say, well, wait, I want to restart at some other time, but I'm going to pay back the benefits that I took at this point. What you're talking about is, yes, there used to be a clause that would say when you got to 70, which is full retirement, you know, the max retirement amount, you could go back in and recalculate and do like a catch-up clause. That does not exist anymore.
So you get a small mulligan, but not a big one.
Yeah, no. It's a very small one because it depends, you know, so like you and I, our birthdays are at the end of the year, right? If I elect, that's my year of FRA.
Right.
I have like a month or two to make this decision.
So very, very tiny mulligan. Correct. Hey, I have a question from the audience, from Patty, who's asking, is there a break-even year? I think if we've done the math on this, it's what, about 13 and a half years, 14 years, somewhere in that neighborhood?
Exactly. So if you do it out, if you say, and really, Patty, what we're doing, when you do that, the only way to really sort of look at it from a truly apples to apples type of view is to say, I took the benefit early and I just poured all that money into a bucket. Let's call it bucket A. And instead of doing that, I waited to FRA and I took all that benefit and I poured it into bucket B. As Craig said, if your full retirement age was 66, at about 77, and it's like 7 months, somewhere in there, 78 or so, bucket B has more money in it. Versus the money that's flowing into. Now, this isn't saying what you did with the money in bucket A, because, you know, if you're 62, that's 4 years you've had benefit where you could have been using it or investing it or doing other things with it. I'm just saying it from purely, I just poured the money into one bucket versus the other. Once I get out to that point, I'm going to start having more money in my later years. And then this gets into the whole, you know, health and longevity question. Whereas in my 80s, am I better off having that additional bump up? Because as you can see, if you wait, once you get past FRA, for every month that you delay, the benefit goes up by, it's like just under, it's about 0.70. It's just a little bit less than 3/4 of 1 point every month. So if you wait, it goes up by almost 8% a year, every year you delay.
So the issue would be if you don't have longevity in your family and you died early, then you would lose.
Yeah, then there's the opposite conversation. Then it's like, well, wait a minute, I'm better off probably collecting here in a little bit early, and we'll talk about some of that strategy stuff and how that affects you and the penalty and going through it. But that's the conversation is, so everybody's unique in terms of where they are, health concerns, longevity in the bloodlines, that type of thing, to say, when should I do it? But if you delay, it's going to go up every month, regardless of when you decide to collect. Every month past FRA, that benefit number goes up. The conversation for most people is maybe they don't want to continue to work. It's great to say, yes, I'm going to wait till I'm 68 or 70 to collect Social Security. But if I'm stopping work at 65, how am I generating that money coming in? And that's where the disconnect happens, is you've got to have something that's bridging you to that point. If you haven't thought about it, trying to build the bridge to get you there, or to look at the reality of you can't do it. So you've got to start making that election at 65 or 66 or doing what you can.
And I was a question I don't want to answer in the chat box because I think you want to handle it. Is Social Security going to go bankrupt within the next 10 years?
Okay, so I did not put it in there. It's originally with the Social Security and Medicare slide. So I'm happy to answer it because it's usually with the way we do it is tell me if you've heard this one before, right? That Social Security is going broke. Yes, the answer is the slush fund in Social Security, the overage amount that's there is going broke. And the last report was like 2035. So what's going to happen here is you are probably going to see some sort of tweaking happen. It's going to have to come about where it's either going to be the next generation down has to look at this and to say maybe 62 is no longer available to them. Maybe it's going to be 63 or 64 that they can start collecting at, and maybe it's going to be that there'll be some sort of either increase on that cap amount, right? 142.8, there's been talk about trying to go to 400,000 on that, right? And trying to drive up that because you're going to build in the base that's there. The reality is right now is that you have more people taking out than you do paying in.
It's because of you baby boomers, right?
The baby boomers are the problem. Yeah. So, I'm a baby boomer. So the baby boomers are the problem. And the front edge of the baby boom generation, the oldest baby boomers are turning 75 this year. That's 10,000 a day. The end of the baby boomer generation, which is just a year or two behind me, that, in 10 years, you're going to be moving, several millions of people onto Social Security over the next decade. And that's really where the worry is, because that's what it all transitions to, is that you're going to have, almost half the population over the age of 65 when you get out past 2030, almost to 2040, in terms of the total population for the US.
I got another question in the chat box, buddy. I have someone asking, I was born in 1959. What is my early age and full retirement age?
So I'm happy you asked that, because we're going to slide right into the slide that's going to answer that question for you. We didn't prop that in, but so if you are born from 1943 to 1954, your FRA is 66. Just realize that for anybody born from 55 to 1959, all you do is take an extra 2 months for every year. So in the case of you were born in 1959, your FRA is 66 and 10 months. You are right at the edge of the, where we are for the rest of the world born after 1960, which is 67. So that means for you, and we'll talk about what happens in the year of FRA, But for those that fall into this category, FRA, that full retirement age is the year that you're turning, in this case, 66. Your FRA is 66 in 10 months, but we'll talk about how that works and the calculation that goes along with it. But that's how it is. It's anybody born, before 1954, it's 66. And then you can see anybody born after 1960, it's 67. And that would be another one of the other ways that they would be looking at changes. Like we just talked about, some of the ways to sort of keep the slush fund moving a little bit is maybe to tweak FRA to another year, go to 68, right? That type of thing. Keep delaying FRA out, because then you're paying lesser benefits as it goes along. At some point you have to grandfather people in. So maybe, I'm on the edge of the baby boomer generation. So selfishly, I'd say everybody who's not a baby boomer gets hit with that, and I can slide in on it, but there are ways they do it. They've done it before. I want to say, when was the last time this was done? Was like the Reagan era, right? And Reagan.
80s. Yeah.
Yeah, they changed the numbers. They moved some of this and made some tweaks to it, which kind of helped. They got a lot of resistance, and you're always going to get a lot of resistance anytime you're trying to make changes to Social Security. But some of this is for the ultimate benefit. But it's right now, I think it's more on the younger generation than it is the boomers or the older generation, because I think there's no way they're ever going to move those benefits where they are today.
Well, it's because it's politically unpopular to touch people's Social Security benefit. That's why.
God bless, like a hand grenade in politics.
Here, I don't want to touch it. You touch it.
You take it. All right. So let's talk. When we talk about claiming, there's 4 things you need to be thinking about. Sort of, I'm going to say them, and Craig and I sort of use this as 4 concepts to be thinking of when you're looking at when am I going to claim or how am I going to claim, right? And so the first one is the earning limit. And we're going to talk about that. We'll break them each down, but it's every year Social Security allows you to earn X amount of dollars before there's a penalty assessed on your benefits. And we'll break it down and go through that with you in terms of how that works. The types of income that counts for earnings. So you got to be aware of what counts or what doesn't count for those earnings limits if you're trying to collect and work at the same time. What happens prior to reaching my FRA if I decide I want to collect and still work? How does that all shake out? Mm-hmm. And then what happens in the year that I'm going to turn is 66 or 67, depending on your FRA and what happens there. So the earnings limit, very simply, if it's prior to your full retirement age, so let's just use 66 as the example, right? So if you are younger than 66 and you decide that you want to collect Social Security, but you're still working, Social Security says you are allowed to have an income of $18,960. And if you are at that or below it, then you can collect the full amount that you are entitled to from Social Security. The penalty for going over that number is $1 for every 2 that you are over the limit. And I'll break it down. We'll go through an example with you and break that down. But it's essentially for every $2 you are over that $18,960, Social Security is going to deduct $1 from your benefits.
Now you're doing math. It's like I have 5 apples and I gave Johnny 3 apples. How many apples do I have left? Right?
Yeah. What happened if somebody snuck in and stole one of my apples while I was doing the math?
And then I ate the other one. So
yeah. By the way, we have a word for that when somebody comes in and takes something from you that you weren't expecting. We call it taxation. All right. So then in the year that you are turning FRA, so again, 66. So I'm going to be 66 sometime this year. I can actually earn up to $50,260. And the penalty changes. It goes from, instead of every $1 for every 2 I'm over, now it's $1 for every 3 I'm over. So it's much more beneficial to be waiting to collect in the year of FRA because it opens it up. And again, depending on when your birthday is, if it's June, that's a number you're gonna have to earn by June. Because that's when once you get past FRA, we'll talk about that, it sort of lifts everything up. All right, so the types of income that are counted when we're looking at that earnings limit is really just W-2 wages, what you're getting paid by your employer, or if you have self-employment, 1099 income, some sort of a side hustle or gig, you're a consultant, you get paid by somebody else. Those are really just about the only two earnings limit. Now we're going to talk about another penalty that comes up with Social Security in a couple of slides. That's a taxation thing. This has nothing to do with that. This is the earnings limit penalty. So if you get a pension or distributions from a retirement account or an annuity or rental income or anything like that, doesn't count to the earnings limit for that 18,960. So you're gonna be making a ton of money from rental properties and still collect your full benefit, and they won't affect you at all.
Got a question from the
Huh?
got a question from the audience, Tom. Said, so this one is says, so I'm just barely past my FRA, would have fulfilled it in May. Does that mean I can claim benefits and earn as much as I want without a penalty?
So I am going to answer that as yes and no. Okay? So not to be really, in terms of going through that with you, but here's the thing. So the answer is yes. So once you pass FRA, the penalty, the earnings limit thing, the lid gets pulled off. We have a slide later that just says it. That's all it is. It's just that there's no limit, there's no earning. You could make $1 million. They're still going to pay you your full benefit amount. The reason I say no, and we're going to talk about it as we get through this, they're going to tax you on your benefits. And we'll talk about how that all works and why that becomes a problem in this. But from the penalty portion, hey, they're going to try to take away some of my benefit dollars because I'm earning. Once you pass FRA, that's off the table. You can earn as much as you want. The question is, when it comes down to taxation, why that can be hurtful. And we'll go through that scenario with you in a couple of slides. All right, so let's look at just an example to sort of go through this, because you have to do some math. As Greg said, there's some math that gets involved, which is why this gets a little complex or convoluted for a lot of people. But let's take somebody who's 63. If they were born on September 1st, they're earning $40,000 a year. They filed for benefits at 62. However, their FRA, their PIA amount would have been $2,400. But because they filed at 62, it's 25% less. They're only getting $1,800 a month, but they're working and getting $1,800 a month. That's how this works, okay? So now what happens now that they, prior to FRA for them? Well, you got to do the math. The first thing you got to do is you got to calculate what the monthly earnings limit is. It's not an annual thing. It's a monthly number for Social Security, because Social Security pays you out monthly. So you got to take the 18,960 and divide by 12. Get 1,580, 1,580. That's sort of your monthly allowance, if you will, that you can earn. You take your monthly income that you're earning, say it's W-2 income, that's 40,000, which divided by 12 is 3333333. Right? So in terms of going through that, I take the 3333, I minus the 1,580 monthly income minus the allowable equals what I'm over. And when I do that, I get an overage of 867. Again, it's $1 for every 2 over that I earn, which means that my benefit is going to get deducted by 867. I'm getting $1,800 a month in the example, minus the 867 leaves me with a benefit number of 924. So that's what happens. If you're prior to FRA, that's how the overage works. They calculate everything on a monthly basis. So if you're getting the W-2 salary, this is fairly simple to plug in and say, okay, I know what those numbers are. But if you're getting hourly wages, or maybe getting some other, pay or consulting gig, or you got something else going on that's bringing in, W-2 income plus 1099 income, and that can rise and fall on a monthly basis, you have to go through and recalculate every month to figure that out.
So it may be another reason to delay claiming if you're still working or getting an extra income stream.
It's possible, right? So that's part of the other is you can sort of flip the side to that and to say, well, you know, they're offering me the ability to lower or limit my hours here. You know, I've been doing 40, 50 hours a week at my job. Now I only want to work, you know, 24 or 30. I can bring that number down. And now, hey, maybe I can fit in all of this and I'm not going to get hit with such a bad penalty. And maybe I'm bringing in close to the same number that I was, but I'm working less.
So there is no right or wrong answer. It really depends on the
Right.
individual.
Oh, it's completely individual for everybody. That's the whole thing is you can't, that's it, you know, Social Security, they don't really answer your questions because they realize everything's an individual calculation depending on what your circumstance is. And as Craig said earlier, like if you're somebody with a health history that, you know, the family doesn't have longevity, well, then it might make sense to really look at trying to take this benefit because you may not make the break-even point. You may not get past that point.
You already have some significant medical issues and right.
Correct. Now, the same thing happens when we're in the year of FRA, right? So this is now I'm turning 66 this year, right? I can earn up to 50,520. Well, again, same thing. I got to divide that number by 12 and I get 4,210 a month. In the previous, the example of the individual that we had before, they were less than 4,210 a month. So they could collect in their year of FRA, their full salary and get their full benefit with no penalty. But again, the penalty is $1 for every 3 that you're over. So, it's a much more lucrative as far as waiting for that.
So I have 2 questions for you, Tom. One's in the chat box. It says, so if I'm still working full time until age 67 or 68 and I'm healthy, I shouldn't claim, right?
Oh, if you want me to answer that, I'm going to say yes. And the main reason for that is I'm going to come up in 2 screens with that, you know, as to why. It's more to do with you can get the benefit, but you're going to trigger a tax on your benefits. Okay. And the tax is going to get levied. It's probably going to be very heavy, depending on what you're earning. And it might not make sense then to say, well, why am I taking the benefit if I'm going to be paying taxes on it? And oh, by the way, when we get to it, because we'll touch on briefly Medicare, how that may impact your Medicare premium as well. Second question.
Is that the Aries mascot in the background I keep hearing?
Yes. That is my daughter's dog. Thank you very much.
The pretzels with your beer?
Yes, pretzel. That is pretzel. All right, and then so like we said, the question that came earlier, so I'm going to spend time here, but if you've achieved FRA, then you're over and above. So one of the things I do want to say that and bring back to on this with this whole thing about the penalty, right? That you could lose some of that benefit, like in the example we gave, they would lose $867. That money is actually not lost. They take it away from your monthly benefit, but it actually gets tacked on. You can actually claim that later. They'll stretch it out over your ability to reclaim it out over time. It's taken away on your money. It's not like that's one of the misnomers out there is that, hey, they took the benefit away and I'm never going to see it again. Well, depending on how long you live, they'll pay you out, but it's based on your mortality table, a little bit extra every, you know, in terms of extending the claim amount and the benefits that you have available. All right, so just to recap real quick, below FRA, again, this year it's 18,960. Next year it'll go up again. $1 for every 2 over the limit. In the year of FRA, it's 50,520. $1 for every 3 that you're over the limit. And once you hit the month of your FRA or beyond, 0. You can earn as much as you want. There is no penalty to your benefit.
And I also got a question from Patty in the audience. Is that reclaiming automatic?
Yes. Yeah, they do it automatically. Well, if you get some withheld or anybody gets the stuff withheld, they'll do it. It's built into the system on that. So it's not one of those things like, hey, you have to file or reclaim it. They build it in.
Chase it down for 6 months to the federal government, right?
Yeah, you know, it's the government, so it's going to take, but that's the whole thing. It's not like, hey, they're going to pay you it next year or they're going to pay it to you in 2 years. You know, they're going to pay it to you over 21 years, basically. You know, in terms of whatever the mortality says, they're going to try to pay that out. Mm-hmm. All right, so here's the reason that you would not, and this is the answer to that question. This is the no side of why you would not file now if you are past FRA, still working and healthy. You know, besides the fact that your benefit amount keeps going up and you're earning, but the other is that your Social Security benefit gets taxed, and it gets taxed anywhere up to 85% of the benefit amount based on what you earn, right? So if you're a single filer and you earn more than $25,000 in a year, then your benefit is going to get taxed at 50%. And that 25,000, unlike the earnings limit where it just looked at W-2 or 1099, now brings all that other stuff into it. It brings pensions and retirement accounts and dividends and anything that you've paid income taxes on. And so for most of us, that's our retirement accounts, right? I'm pulling money out of my retirement account because that's what it's there for, so I can live in my retirement. But now that's generating taxable income to me, and I've got taxable income, so Social Security is going to look at that and say, well, hey, if you're over that amount, we're going to take some of that benefit away in the form of taxes.
So that's why having a good liquidation strategy is so important.
It's absolutely necessary to figure it out. We'll talk about it the last slide before we get into, you know, to close it out, is all the things that don't count as far as income is concerned. But realize, just understand that it's not like, hey, I got to 25,000, it's 50. I got to get to 34,000, it's 85. It's a graduated scale. So, you know, you get to 28,000, I'm going to take, you know, the 62% and so on. And it's a graduated scale based on where you come out. And so if you're working and your net income after your standard deduction is higher than 25,000 if you're a single filer, or 32,000 if you're, you know, married filing jointly, then you're going to give away 50% of that benefit in taxes. And that's taxable income that's going to show up when we start talking about, because we're going to talk about Medicare real quickly here in a second. But that's what happens to most people. Don't realize that it triggers an additional amount that can be a surcharge premium on your Medicare benefits. So Medicare, real quickly, I don't want, you know, this just, it ties into it, because one of the things that happens with Medicare, you know, it's the whole I'm filing for Social Security thing. So, you know, Medicare Part A, when you turn 65, you file for Part A. It's free. They give it to you. There's no cost. And it becomes your primary when we talk about hospitalization, regardless whether or not you're still working or not. You should file for Part A. You don't have to, but it's a good idea to do it. Part B, this is what you pay a premium for. You have to forgive me, but I blanked on this year. Like last year was $144 a month for basic Part B. I believe that's where it's at. You know, it probably went up a little bit this year, but it's $144 a month for Medicare Part B. You're paying for that. If you're still working, you're getting coverage through an employer. You don't have to claim B until you separate from service. Once you separate with your employer, then you file for Part B. You can do A and B at the same time, but like I said, most people at 65 will just file for Part A anyway. And then you have Part D, which is prescription drugs. So you need some sort of drug plan that to have, whether you're getting it as a separate just medication plan, or we'll talk about a supplemental plan that fills that in. And that's the next thing, right? So you have supplemental plans to Medicare. Most of the time you're going to hear these are called Medigap plans, right? So Medigap is, I'm going to cover everything that Medicare doesn't cover. In Part A, even though it's free, if you get hospitalized, there's an $1,100, or at least it used to be, I think it's $1,180 now, deductible. A gap plan will pay that deductible. In Part B, you've got co-pays and other things. The gap plan will pay for that. The one thing the gap plan doesn't pay for is Part D. Gap plans no longer, they used to, now they no longer have prescription medication plans on them. So this is sort of, you've got to get A, B, D, and a supplemental or a Medigap plan if that's the way you choose to go.
Mm-hmm. Is there a Part C?
Part C, there's Part C, CUX, right? So that's.
Thank you.
Part C is Medicare Advantage. These are, think of these as the HMO plan for Medicare, right? So it works very, very similar to what your current employer health plan looks like, right? You've got co-pays, you've got deductibles, you've got a monthly premium. There's can be prescription drugs on them. Generally, a Medicare Advantage plan is better for somebody who's healthy and doesn't have a lot of prescriptions, right? That's usually the best fit for Part C. If you're somebody who's, got some health issues or some concerns, the GAP plan is probably going to be better with a Part D prescription plan, because you'll probably get your drugs in a better, the medications in a lesser cost.
I have another question from the audience, Tom. I have a different insurance companies hit me up about these parts, right? Probably the supplementals. Can I buy it from the federal government?
So not Part C or the supplemental plan.
It's not offered through them.
Right. It's only A and B. Now they are, there's multiple, yes, unfortunately, as you have found out, once you got close to 65, the mailbox just got filled with flyers and emails and everything else that could possibly come from it. And every October, they're going to do it to you again, because you can switch your plan every October. So you're going to get hit with the every year, hey, here's what a new change is, here's what's coming, because a lot of these plans do change, right? They make changes to them. Some of them you get grandfathered into, some of them they close you and move you to something as close or as similar as possible.
And we do have somebody in the audience who thinks that you can only buy these supplemental plans from BCBS or AARP. And I think there's just like many plans out there as there are fingers on my hands, right?
Correct, right. So AARP is just using one provider. There's a provider that they use as their choice, which I want, I just blanked on the name there. Never mind. It'll come to me. I get through a screen and all of a sudden I'm going to scream something out. So just
who AARP uses.
my head. I'm like, hey, I got it. But Blue Cross Blue Shield is in Massachusetts certainly is sort of the premier provider when it comes to Medigap policies. The bronze plan is right there in terms of the Medigap bronze. They just will cover everything. And let's face it, most doctors out there for long periods of time, everybody took Blue Cross Blue Shield. That's why it became sort of that standard bearer for it. But as Craig said, Harvard, Tufts, Fallon, they all have Medicare plans, along with, Humana and some others that are out there. There are lots of them that are available, and it just depends on what you're trying to do and to find the right fit and your doctors and whether or not they fall into that plan. That's really what it's about. Go ahead.
I'm sorry, I had another question come up.
Sure.
Are you automatically enrolled in Part A, even if you are still employed and in the employer's plan?
No, so you are never automatically enrolled. You have to sign up. Now, if you are, so sometimes what will happen is, depending on your employer, if you're a large employer, you've got more than 100 employees type of thing, then that plan will always sort of step in front. It's small employer plans tend to take a back seat to Medicare. So it's just always a good idea, because you never know what could come up. Whereas you might have a very robust plan through your employer, but Medicare could pay for something. Again, Part A, it's hospitalization. There's nothing to do with your doctors or visits or any of that type of thing. So you just always want to make sure what's there, but there's no cost and there's no penalty. There's a penalty if you don't sign up for B once you lose your coverage, once you stop working. But as long as you're working and you're covered under a plan, you don't have to sign up for B. Most people like to do A and B at the same time. That's why delaying isn't that big of a deal. But it's just something to recommend, to say, look, you can always do it. They'll ask you about Social Security. They'll ask you about Part B, but you can tell them, I'm still working and I'm not collecting at this time, and then they'll let you go. And
I know you're required to, to sign up for it at 65. But what happens? The question is here: what happens if you don't? What happens if
Part A, nothing?
Do you lose your entitlement? No.
No. So with Part A, there is no, there's no penalty, there's no nothing for it. Again, it's free. So, they don't care whether you're on it or not.
Mhm.
The conversation is, once you separate from your employer, part B, you will get a penalty if you do not sign up. You got like 3 months to do it, but once you separate, then you sign up for it. If you haven't signed up for A already, they'll walk you through that and say, hey, well, now you got to take A and B. But there's no penalty, there's no nothing for not signing up for it. It's just one of those things that's free. Like I understand it's a headache trying to deal with Social Security sometimes. That's why a lot of people don't do it if they continue to work past 65, that they'll just wait until they actually have to go sign up for B and then do it all at the same time, collect their benefits, do all of that in one easy, all right, I'm doing everything at once.
So you're saying that if you don't sign up for A, there's no penalty, but if you don't sign up for B, if you don't sign up for it 3 months within separating from service, there could be a penalty.
There will be a penalty.
There will be a penalty.
Increase your premium amount.
But if I, let's say, for instance, work to age 70, I wouldn't have to sign up for B until I actually stop working at age 70 in 3 months. I'd have to have signed up for it.
Right.
Okay, all right.
Yeah, no, there's no age limit on it. If you're still working, if you're still covered. Now, some employers at a certain point do move people off because they age out, and they won't cover them anymore. So there is that conversation, but for the most part, it's a more of a conversation of when you separate, that's where the ticking time, the clock goes off. You got to start, thinking about it.
And does C fall into the same category as B as far as when you need to sign up?
No, so C and Medigap go hand in hand with B.
So you're going to do it at the same time.
Correct. Well, so you would look at it and doing it based off, all right, now I've got A, now I've got B. What do I need to fill in now? Do I want, you don't have to take a supplemental plan. You don't have to take Medigap, but B is not going to cover a whole lot. And you should have a prescription drug plan. So you want to make sure you've got, pieces in place. And then that becomes a conversation. Well, I can go an Advantage plan instead of going D plus a gap plan. So maybe the Advantage plan might be better for me.
Is there an earliest time that you can sign up for these plans, A, B, and C? Like you have to wait till you're 65?
60, wow. So the 65 for Medicare, the only thing that kicks in is if you qualify for SSDI, but that's Medicaid.
Okay.
It's not Medicare.
Right? Then it's a whole nother animal, another set of topics. Yes.
All right. So then, so the penalties, what we were talking about there in terms of, so one of the things with Medicare is in the same conversation, right? So when you talk about Social Security going broke, the other thing that's going broke is Medicare. Medicare is under more pressure because the paying into it is a lot less. And there's more and more people using the services of Medicare because everybody gets it when they turn 65 than Social Security. So there's a lot of pressure on it. And that number is like 2032 right now. So you're going to see some tweaking here with this. One of the things that Medicare has not done is they charge a surcharge if you have too much income in your retirement years. And they haven't changed them. These numbers have stayed the same for the past decade. And what Medicare just said was originally they were going to make an assessment and a change in 2024. They've delayed that to 2028. So these numbers are going to stay as they are for the next 10 years, right? Well, for 2018, but for the next 7 years until 2028. So just to go through that scenario with you, let's say I'm in retirement and I'm taking money from my retirement account. Let's just use a number and call it $60,000 a year. Well, that's $60,000 a year of taxable income to me, which means I am over the Social Security limit so that my benefit is now going to get taxed 85% of it. And whatever that number is, let's just say that adds another, $18,000 of taxable income to you. You got to pay taxes on the Social Security. Well, that 18,000 now gets added to the 60,000. If you had dividends, if you had distributions from municipal bonds, which we have been told our whole lives are tax-free, but when you take a distribution from a municipal bond in retirement, that gets added on top of that number. And if we go over 85,000, we get a surcharge on our Medicare premiums. And you can see the number there is if you're an individual, right, not filing as a couple, you go over 85,000, they're gonna surcharge your Medicare premium 23%.
Well, Tom, I think I understand the question from the audience of how it's calculated. Is this adjusted gross income? Is this after deductions? Or is-
Right, so it'll be after your deduction. You have to take, you take your standard deduction and go through that, absolutely, right?
Okay.
But then they start stacking everything on top.
There.
Right? And going through it. And so, that's one of the things that gets into the whole conversation about, well, how does that work? And does it make sense for me then, right? If I'm taking it out, would I be better off maybe taking some distributions before I start claiming my Social Security, or doing maybe some Roth conversions in those years that I can do it once I stop working, because now I've taken that income before I penalized my benefit, and I'm not going to get taxed on it, which is going to trigger me up. So there's all there's these moving pieces and variables that go through it, but it really is that, as you start looking at what you're, somebody who's working and start looking out, 10, 15, 20 years out into the future, the income that's being generated and what you're trying to replace with your retirement income starts triggering this, and they're not going to change it. So one of the things we talked about was that modified adjusted gross income, right? So what increases that modified, that's how Medicare and, all of that is looked at. So again, it's Social Security, it's salary, it's pensions, it's required minimum distributions, dividends, capital gains, anything from a retirement account, and those distributions from municipal bonds. Even though they were tax-free, if you take a distribution from it, they're going to count it against Medicare. What doesn't count is any life insurance that you have, non-qualified annuities, i.e. annuities that are not under an IRA umbrella retirement account, health savings accounts, which are a triple tax benefit, because not only are you putting the money away, getting a tax on it, but then you can take it out and have it be tax-free here and then not count against anything. So HSAs are wonderful tools. Roths. So always important to look at what you can do with a Roth, and maybe start looking at where your current tax rate is, and maybe could I take a little bit of a conversion in this year, and I'm not triggering too much of a tax penalty, but I'm building up this Roth portfolio that I can use to withdraw money from. Longevity insurance, that's just deferring payments. That's like turning on your own personal pension type of thing. Like I've got these deferred payments that are coming from an annuity that's going to pay me on a monthly basis. I don't get taxed as much on that. And a reverse mortgage, there's another thing that doesn't count in terms of going through it.
Just to give you a heads up, Tom, we're at 6:24.
Okay.
So a lot of information though, and a lot of
I know
interest.
there's a lot, and we try to keep these as quickly as possible, but right at the end, right? This is where we are in terms of the end, right? So for us, again, the Aries Foundation is always about trying to help everybody, sort of figure out what's ahead, right? Because that's the whole idea. Nobody knows the twists and turns that are coming, and it's our goal is to try to help everybody sort of get that clear vision of where they want to be, how they want to get there. And in this case, when we're talking about Social Security and how that's going to affect it, how am I going to claim that? And as Craig said, how am I going to be efficient with taking the money out? As we said to you, one of the things that we are offering to everybody who's on the call here tonight, the webinar, that we'll do a free analysis with you. Basically all you got to do is if you just type yes into the chat box, we'll reach out to you and we'll set that up. It's a simple little questionnaire that just asks some health questions, right? Because you got to know about longevity, but then about where you're at, what you're trying to do, and when your qualification would come and what that would look like. So we're happy to do it. There's no cost, there's no obligation. It's a free tool it'll line that up. It'll line up not only Social Security, but Medicare in terms of how that all is going to work.
Well, and if this wasn't confusing enough, you also did the one a couple of weeks ago called the retirement gain, right?
All right. Well, that's where we get into the whole craziness of all the income that gets involved and how you deal with all of
I'm just saying you could go to our library and actually through Aries and see that video and confuse yourself even more if you want.
Yeah. It is a game though, right? There are rules. Yeah. If you're going to play retirement, it's a retirement game. You do definitely have to follow the rules that are there. So one of the things we ask of everybody is that, we ask an evaluation form. We just like to get feedback. Are you getting some value from it? Are there certain topics that you'd like to see? We sort of build this library out as we go, as we get feedback from people. So if there's topics or concerns or things that you're interested, just send that to us, let us know. One of the things that's in there is there at the top, there is a yes and no box. If you check no, just know you're never going to hear from us, right? The whole intention of Aries is trying to help everybody have that relationship, but we do ask that you do the feedback for us because we appreciate that. But if you check no, you're never going to hear from us. If you do want to go through the Social Security thing, if you didn't type it in the chat box, you can check the check box on the evaluation form. I'm hoping that my co-pilot is dropping that into the chat box right
It's
now.
right. It's in there right now. I put it in there as you started your
I
conversation.
think we had this down in some sort of a well-oiled machine.
I wouldn't go that far.
This is Craig and I in our more formal attire when we are out and about in the world, right? So we do a lot of community outreach. We do a lot of workshops. We do a lot with organizations and companies. So the other is, if you know an organization or a company, that could benefit from hearing some of our topics, some of our workshops, introduce us. That's what we're trying to do. We're trying to spread the word of Aries, but we go out and about and we have some fun when we try to do it.
Also, invite your friends to have a drink with you while you listen to us some Thursday night.
Yes, there you go. So you make it a party.
Mm-hmm.
So next week, we're going to do why is credit important? What does that mean? And then on the 7th, we're going to do handling financial stress, dealing with financial stress. That's the issue. And then if you ever have questions, you can always reach out to us. It's info@ariesfoundation.org, or you can go to the website. There's a contact form on there. And as Craig said, you can check out some of the workshop titles, some of the stuff we do. There's a blog page. We've got our YouTube channel that you can check out some of the titles that we've done and check those out. But you can go to www.ariesfoundation.org, and that's going to wrap us up. Craig, any questions for us left in the chat box?
I have no other additional questions. I want to answer it. Maybe you want to answer it more thoroughly. So what if I have an ETF that includes a whole, oh, wait a minute. So the question was, so the amount we claim as income under federal income tax is what determines the Medicaid portion, right?
The
Medicare. And I said, that is correct, except for some income from municipal bonds or securities, which you talked about. And so the question was, so what if I have an ETF that includes a whole slew of assets, including bonds and stocks?
Right. So if you're getting dividends from that, those dividends, even though you didn't sell it, right, the fund may sell it itself. If there's a dividend that's generated, or you sold some and got a capital gain, both of those count. They get added on. They get stacked. You got to think of it like almost stacking. My income is my income, whether that's on W-2 or distributions from a retirement account. Mm-hmm. Then I got my Social Security tax. I'm going to stack that on top. Then if I've got dividends and capital gains, I stack that on top. And once I get past that 87,000, they're going to put a surcharge on.
And one more question, but you've got to put your hands on the side of your head like this first, so it doesn't grow. Is how are you so awesome? That's the question we got. I don't want your head getting too big, so you got to squeeze it.
I certainly appreciate that feedback, and thank you very much. So like I said, for Craig and I, between the two of us, we've been doing this now for more than 40 years combined, right? So, but for me personally, I deal with a lot of people who are transitioning. They're going from their working life to now their retired life, and Medicare specifically was one of those major questions. And then how that all teams into and ties into Social Security became really one of the focus points, right? Trying to stay on top of it, as you can see, there's a lot of information. There's a lot that you need to do. So it's always trying to make sure that we've got some of that, and we reach out to people for answers. We go to Social Security stuff and listen to them and other professionals on that, just so we can stay on top of that topic.
Well, the other thing too, Tom, is everybody's looking for cookie cutter answers. I should do this or that, yes or no, right? The issue is there are no cookie cutter answers, and it's different for everybody. Like you said in the beginning, money is not math, money is emotion, and it's also your situation, right? So everybody is different, and everybody should be treated different when it comes to dealing with their financial situation.
Right, absolutely. So a wonderful audience and great questions tonight. Like I said, any questions on anything, feel free to reach out to us. Want to take advantage of that analysis, that the Social Security claiming report, feel free to shoot us an email or just drop us a line or do the evaluation form and send it back. That would be a great help to us. So I'm going to say goodnight. I'm going to stop the share and say have a great evening.
Thank you
Thank
so
you.
much.
You're welcome.
Bye.